The City of London, the centre of the financial world. It's here that some of the finest minds in global finance ply their trade. The pressures are huge, with salaries and bonuses to match. London's financial services sector encompasses a whole range of commercial activity, from banking and merchant banking to insurance and accountancy. But central to it is the fund management industry. It's fund managers whom the vast majority of us entrust with our long-term investments. They choose which stocks and other assets to invest in on our behalf, and they decide when the time is right to buy and sell. And yes, they are very well remunerated. In fact, pay has risen sharply in the last few years. One manager, Richard Woolner at M&G Investments, was paid £17.5 million in 2013, 600 times the average UK salary. Research by the FT shows that in the same year, pay per employee in the sector outstripped even investment banking. At one fund management company, the average annual salary was £436,000. The standard line from the industry is that we need to offer such vast financial rewards to attract the brightest talent. But time and again, research has shown that we overestimate quite how talented fund managers are and how much value they add. For all the talk of star performers, the empirical evidence shows that only a tiny fraction of them are able to outperform the market with any meaningful degree of consistency. Typical of the reports produced on this subject is this one by the Pensions Institute, based at Cass Business School in London. Researchers examined 516 UK equity funds between 1998 and 2008 and found that just 1% of managers were able to produce sufficient returns to cover their trading and operating costs. But even those managers pocketed for themselves any value they added in fees, leaving nothing for the investor. The remaining 99% of managers failed to deliver any outperformance, either from stock selection or from market timing. In case you're wondering whether those managers were simply unlucky, the researchers found the vast majority weren't. They were genuinely unskilled. While a tiny number of star performers do exist, they are, to quote the report, incredibly hard to identify. Furthermore, it takes 22 years of performance data to be 90% sure that a particular manager's outperformance is genuinely down to skill. For most investors, the report concludes, it is simply not worth paying the vast majority of fund managers to actively manage their assets. If you're shocked and appalled by those findings, so you should be. The Pensions Institute report is a damning indictment of the fund management industry and is completely at odds with this image we have of the city as a centre of investment expertise. Since this is only the latest in a long line of reports that have said more or less the same thing, it also begs the question, why are so many ordinary investors completely unaware of this scandalous situation? In fact, there are many reasons. This is a hugely powerful and largely self-regulated industry which lobbies hard to protect its interests. It also spends a fortune on advertising, and the financial media, which is largely funded by those adverts, has an insatiable demand for stories, which the fund management companies are only too happy to provide. But ultimately, actively managed funds still hold sway over cheaper passive investments such as index funds because investors continue to buy them. We think we're paying for better performance, that greater skill will produce superior results. But investing almost always works the opposite way round. The less you pay, the more you get back. Yes, it's counterintuitive, but it's true. In the course of this programme, we're going to be looking at just how much investing costs us and at the performance provided by active fund managers. We'll also be exploring more than 100 years of academic research into asset pricing and how markets operate. And we'll be investigating some long-term investment strategies that have been proven to work. Investing was once famously described as the loser's game, and for most people, it still is. we're going to show you how to win it. We love a bargain. We drive several miles out of our way to save a penny on a litre of petrol. We collect vouchers to save a few pence on grocery items, and we grumble when the government slaps another penny in tax on a pint of beer. And yet, when it comes to our pensions, one of the biggest financial investments we'll ever make, often the biggest, we either don't know what we're paying or don't even seem to care. One explanation is that when you start a pension, retirement is so far off that you're not particularly concerned about the impact of charges on an investment you might not need for another 40 years or so. But another problem, at least here in the UK, is that charges are complicated and sometimes very difficult to calculate. The True and Fair campaign, which lobbies for fairer and more transparent charges, accuses the industry of using smoke and mirror tactics.
Fund management industry is supposed to publish something called the ongoing charge. That was under an EU directive that came in 2012. Most companies still only publish the annual management charge. Outside of that annual management charge, there can be a myriad of other charges, between 11 and 13 layers. You've got jurisdiction fees, you've got bid offer spread, you've got administration fees, you've got taxes, stamp duty. In a way, it doesn't really matter, though, what all these charges are. It's not up to the individual investor to have to become a detective to find out those charges. It should be the industry doing the work to put that all in an understandable number into a ticket price. When you buy a car, you don't expect to see a list of how much the wheels cost or the engine. Or what you expect to see is how much is the car going to cost you.
What we've seen in recent years is an unbundling of charges. The different fees applied now need to be broken down. That's improved transparency, but it's also added to complexity. Unbundling has also made it look as though charges have gone down, when in fact in many cases they've risen since the regulations came in. Under the old system, annual charges were usually around 1.5%, but fund managers would pay some of that to third parties such as fund platforms or financial advisors. Now, although fund management companies typically charge a more modest sounding 1% or 0.75%, they keep all that for themselves. In fact, many funds are pocketing more in charges than ever before, and because there are still separate fees to pay on top of the management charge, investors are often worse off. And of course, all that's before trading costs. Research by Oxford University suggests that many fund managers have responded to regulatory pressure to reduce annual management charges by simply trading more and charging for it in order to maintain their profit margins. The combination of trading costs and the compounding effect of annual charges can take a very large chunk out of the average pension pot, even in America, where overall investment costs are significantly lower than in the UK.
If you're paying big management fees, that the cumulative effect of that, given the way compounding works, is enormous. So active managers basically charge on average 1% in the US in management fees. And you never know what their transactions costs are because that's not a reported number. But they've got to be way higher than they are for passive managers because they're going in and out of securities all the time.
As well as resisting calls to reduce their charges, fund managers have been accused by some of acting almost like a cartel. One survey found that 68% of the UK's largest retail fund sector charged an identical fee.
I think it's a fair point. It is very strange that most of the industry prices at the same point, because what are you pricing for? Expertise. So surely you'd expect someone with superb expertise and great fund management to actually charge more than for someone who's not done so well. But I don't think the industry has got into that competition mode. So cartel, I wouldn't go as far as a cartel. I don't think that's true. But a cosy club, well, maybe.
Another trend that some have observed is the growing number of funds that claim to be actively managed but are in fact virtually passive. In other words, they broadly track the entire index. Passive funds are cheaper to operate than active and should therefore have lower charges.
Yeah, almost all fund management is a complete rip-off. I mean, we know that. We only have to look at the prices relative to the performance and look at, you take a fund and you look at its top 10 or top 20 holdings, and you'll see they're exactly the same as the top 10 or top 20 holdings in a passive fund. So there's a huge, huge market out there full of active funds that are not actually active at all. Or if they are active, this is a very strange definition of active because they're knocking around any old benchmark.
So what sort of impact do charges have on the value of our long-term investments? Well, over 40 years, a pension fund worth almost £250,000 with no charges would be reduced to just £174,500 with an annual charge of 1.5%. If overall charges reach 2.5%, when trading costs are included, that's not uncommon, this reduces the value of the fund to less than £140,000. So even at 1.5%, almost a third of your fund is lost in fees, rising to almost half when charges increase by 1 percentage point. The True and Fair campaign says fund managers are taking far too much out of people's savings and they could easily afford to lower their charges. It says inefficiencies are rife, and although the industry has grown considerably, there's been little or no attempt to pass on economies of scale to the consumer.
Well, the average UK small to medium-sized business is making between 9 and 15% profit, somewhere around there. The average UK fund management in business is making 30% profit. Those figures speak for themselves. They are growing fat and rich while the consumer is losing out. The very people who are being prudent and saving and investing are not the ones who are retiring with a comfortable pot. It's the fund managers who are becoming millionaires and billionaires because of those profit margins.
Of course, fund management companies could justify high fees and making large profits if they added significant value. Unfortunately, the performance of actively managed funds is consistently very poor. The aim of fund management is to maximise investment returns. Over time, markets deliver returns on their own. They're what we call the market return. We pay managers to deliver more than the market return. In fact, after costs, they rarely do. One well-known expert famously described it as an industry built on witchcraft.
We have the most prevalent rule that applies to fund managers everywhere, and that is reversion to the mean. A fund that gets way ahead of the market falls way back behind it. It's witchcraft in the sense that, it's managers hovering over a table thinking they have the answer. I've told people, what is the intellectual basis for indexing? The intellectual basis for indexing, as I've said, is gross return minus cost equals net return, period. What is the intellectual basis for active management? I've never heard one. The closest I've come is a manager says, I can do better. They all say I can do better. 100% of them say I can do better than the market, but 100% don't. Probably about 1% of managers can beat the market over the very long term.
That figure of 1%, you may recall, is consistent with the findings of the Pensions Institute report. And that study found that even those 1% of managers actually recover for themselves the value of any outperformance in fees. Several other reports have reached similar conclusions. This is an independent report commissioned by the UK government into the local government pension scheme, one of the biggest public pension schemes in Europe. As you'd expect, some active managers used by the LGPS have outperformed, but the report found there is no evidence that in aggregate the scheme has outperformed regional equity markets. In fact, in many cases, active funds were trounced by passive ones. For example, over 10 years, passive North American equity funds delivered average returns of 2.6% as opposed to 1.7% delivered by active funds. Passive Japanese equity funds also recorded average returns of 2.6% compared to 2.0% for active. What's more, these returns do not take into account the impact of investment charges. The The report found that in 2012, asset management costs for the scheme amounted to £790 million, the vast majority of which was paid to active managers. Switching from active to passive investing would save the taxpayer a staggering £660 million a year and deliver similar, if not better, performance. Michael Johnson is a public policy advisor with a specialist interest in pensions. He says the LGPS report is a wake-up call for the whole investment industry.
I think it's a seminal moment in the history of investment management or fund management, because it really lifts the lid on what is essentially an industry that adds no value to anybody. Essentially, very few people enter that industry with the express purpose of enriching others, and they're very good at what they do, which is enriching themselves.
Alan Miller was a successful fund manager, but over the years he became disillusioned with the industry and particularly with the poor performance that managers were delivering year after year.
It used to be the institutions had a big advantage. They would see the companies first, they would see the management. If they were asked sensible questions, they would get information before other people. This does not happen anymore. There's something called the internet, there's something called information given to everyone, and therefore to have an edge is much harder. It's a bit like companies drilling for oil in the middle of nowhere that nobody's drilled before. It doesn't mean they're not going to discover oil, but the vast majority are probably going to just discover fizzy water. The marketing budgets within the big retail companies are millions and millions of pounds, and they've created this image whereby the customer thinks that these big brands are nice and safe, nice and solid, and they think they're actually getting something better. They're actually getting something worse. This is the irony in that basically, if you were to sum it up, less is more. The bigger the institution, the bigger the brand, normally the more you pay, and normally the worse the performance.
In a nutshell, you have an industry of fund managers who are trying to outcompete one another in a giant negative sum game. Not a zero-sum game, but a negative sum game, because whilst they're doing it, they are extracting charges and fees on an annual basis, which erode the capital of savers. In this competition of trying to outcompete one another, there are bound to be winners and losers every year. And there will be some who claim that on average they add value, i.e. they win more often than they lose. But if one actually examines the data in detail, as I and others have done, it is nigh impossible to work out who is going to outperform the rest on a consistent basis. And therefore, for virtually all investors, making a decision as to which active fund to invest in is a pure lottery.
And that's more or less what the Nobel Prize-winning economist Eugene Fama has been saying for more than 50 years.
There are lots of studies of persistence in performance. One of my students did a very famous thesis on this, Mark Carhart. He ranked the funds based on 5 years of past returns and did that every year, and then examined whether that predicted future performance. Nope, doesn't. So there's very little persistence in performance. But if I take all the funds and look at them over their entire histories, then you're going to see that some of them did extraordinarily well, and books get written about those managers. But in fact, that distribution is pretty consistent with chance.
We asked several of the largest fund management companies to talk to us about performance, but had no success. But the trade body, the Investment Management Association, did agree to give us its point of view. What evidence do you have that active fund management actually works?
Okay, well, over long periods of time, active managers pick stocks that they believe will go up more than the market. But of course, as a group as a whole, we are the market. So that's why you will quite often see reports in the press saying active fund management doesn't outperform the market. Well, the fact is that active kind of is the market, and passive obviously is the market too. So as a group, they can't outperform the market. What people are trying to do is to find managers that do outperform over long periods of time. And in fact, most people are quite successful at doing that, because what you'll find is that the managers that demonstrate an ability to outperform the market reasonably consistently have the bigger funds, and ones that don't contract quite rapidly. So the lion's share of new money and switching money goes into the funds of people who do outperform.
But Michael Johnson is unimpressed.
That's mathematical nonsense. How can you have, if he's suggesting that the majority of money is successful, how can the majority be outperforming the minority? Doesn't make sense. This is an industry that is a genius at obfuscation and bamboozlement with terminology that is utterly meaningless, and it needs to be challenged.
So what are the implications of all this for investors? Well, ultimately, we need active fund managers to set prices to ensure that we all receive fair value for money. But that doesn't mean that every investor should pay for their services. Indeed, the high cost of active management, combined with its dismal track record and the near impossibility of identifying the next star performer, should make the average investor extremely wary. But before we investigate alternative approaches, we're going to find out what the academic evidence says about investing and the best way to go about it. Investing is often referred to as a game that people play, and the way most of us invest, that's an apt description. As with many games, there's a very large element of luck as well as skill involved, and it's almost impossible to distinguish between the two. But investing shouldn't be a game. After all, securing your financial future is a serious matter. And although the industry and the pundits like to play it down, there is a wealth of empirical research on this subject that investors can draw on. We're going to touch on some of the key principles of investing established by a long line of academics, including Nobel Prize winners. Investing will always involve a degree of risk, but basing your investment strategy on those key principles will help you sleep more soundly and enjoy life, safe in the knowledge that if you stick with it long enough, you will succeed. Our story starts in Paris. It was here in 1892 that a young man from Le Havre named Louis Bachelier came to study at university. Louis Bachelier lost both his parents shortly after leaving school. To support his brother and sister, he briefly took the reins of the family business. But what fascinated him most was mathematics. And at the age of 22, he came here to Paris to study at the Sorbonne. Among the eminent mathematicians whose lectures he attended was the world-renowned Henri Poincaré. It was also in Paris that Bachelier developed an interest in the workings of the financial markets. After graduating, Bachelier stayed at the Sorbonne to study for a PhD. His specific focus was how stock prices moved. Detailed study of the data led him to conclude that all the available information is already included in the price of a stock. Prices react to new information, which is by nature random, and therefore price movements are also random, or as he rather colourfully put it, no more predictable than the steps of a drunkard. In conclusion, he said, the expectation of the speculator is zero.
The expectation of the speculator is zero because when you buy something, you expect that the price is going to rise, but if you buy something, someone else has to sell it, and this other person thinks the price is going to go down. So if you want to have an exchange at the equilibrium, then the buyer cannot have an advantage over the seller. So the price must be such that future prices is completely unexpected.
In 1900, after 8 years in Paris, Bachelier completed his PhD thesis, La théorie de la spéculation, the theory of speculation. It went largely unnoticed at the time, and it wasn't until very late in his career that Bachelier was finally offered the professorial post he always wanted. But the work is now generally recognised as brilliant, and Bachelier as the father of financial mathematics. It was the American economist Paul Samuelson who first recognised the significance of Bachelier's thesis in the early 1950s, several years after the Frenchman's death. The theory of speculation had a profound effect on Samuelson's work. For Samuelson, unpredictability was a necessary characteristic of a well-functioning market. In turn, his work greatly influenced the founder of Vanguard, the company that pioneered the use of index funds.
I am not much of an academic. Many of those articles, truth told, I cannot even understand, and very sophisticated. But the great hero of my life was Paul Samuelson. He had won the Nobel Prize in economics, one of the first American to do so, back in the, I guess, early 1970s. And providentially, the first issue of Journal of Portfolio Management came out in the spring of 1974. And there was an article by Paul Samuelson called Challenge to Judgment. And he basically said, show me the brute evidence that managers can outperform. If you can't show me that brute evidence, you should own a passive market index like the S&P 500, operated at very low cost and no sales loads. And that was the inspiration that basically got me going on the idea.
There's one institution more than any other that's contributed to our understanding of asset pricing and how markets work. Over the years, the University of Chicago has produced an almost embarrassing array of Nobel Prize winners who've researched and written about this subject. I've come to interview its latest Nobel laureate. It was the advent of computers in the 1950s which enabled researchers like Eugene Fama to take financial mathematics to the next level.
I always say the work on markets and the efficient markets theory and empirical work that came out of that basically was motivated by the computer and the freedom that gave people to do empirical work.
It was for his work on the efficient market hypothesis for which Professor Fama was recognised by the Nobel Prize Committee. The EMH reinforces the view of Bachelier and Samuelson that all relevant information is already incorporated in the price of a particular stock. If you take the EMH to its logical conclusion, it's impossible, or at least very difficult, either to purchase undervalued shares or sell stocks for inflated prices. It's also impossible, or all but impossible, to outperform the market, either through expert stock selection or through market timing. To what extent do you think the efficient market hypothesis has stood the test of time?
It's a model. The word model implies that it's not perfect. Clearly, insiders have information that's not in the market prices, and there's pretty clear evidence that they gain from their trades. Once you get past that group, it's very difficult to find people who do have information that's not in the price. So that the proposition that markets are efficient has stood up very well.
What do you say to those who argue that what happened between 2000 and 2003, and again between 2007 and 2009 when markets fell 50% or even more, those who say that that disproves the efficient market hypothesis?
I put this in my Nobel lecture. I put a little plot and I put in recessions on the plot. And what you see is that there are big price declines anticipating recessions pretty consistently. The bigger the recession, the bigger the price decline. So in 2007-8, we had a huge recession, and there was a 50+% drop in the prices of stocks. That happens consistently. Expect it to happen. Bad times, prices are going to go down.
As Eugene Fama says, the EMH is a hypothesis. It's not meant to be perfect. And even though assets are fairly valued today, they could still fall or rise sharply in price tomorrow once new information is known. However, it is generally accepted now by academics who've researched this subject in detail that markets are fundamentally efficient. Yes, there are those who disagree with Professor Fama's interpretation of the facts, but the evidence itself is indisputable.
The core of Gene's research is really facts. when you think about Gene Fama and efficient markets, don't think about Einstein and some big theory that nobody can understand. Gene's theoretical framework is quite easy to understand. Competition means that prices reflect information. What Gene did is like what Darwin did. Darwin had a simple theory, evolution by natural selection. We can all understand that. But he went out and put all the finch beaks together and wrote the big book and saw how every different kind of animal fed into that. Well, that's what Gene did.
It's often said by supposed experts that the theories of Bechellier, Samuelson and Fama are outdated, that they don't do justice to the complexity of today's markets. True, their findings have been known for a long time, but they still haven't been disproved, and if anything, they're more relevant now than they've ever been.
Again, it's all to do with competition, with the principle of equilibrium on which Bechellier based his theory of speculation. Simply put, there are two sides to every trade. For everyone buying a particular stock, thinking they're getting a good deal, there's a seller equally convinced that they are. Now think of the size of the global equity markets today, with millions of investors trading typically around $60 trillion every year. Think of the increasingly high frequency of trading. A decade ago, there was an average of around 20,000 trades every second, but that figure has increased nearly 100-fold to 1.8 million trades a second. Also, think of the growing number of professional stock pickers out there. In the US, for example, there are 14 times more mutual funds today than there were in 1979. All these market participants are competing with one another, and each time they trade, they're giving their estimate of how much a stock is worth. So we should see the price of a stock as the very latest, best estimate of the entire market. That's how efficient markets have become. Of course, investors don't just buy one stock, one mutual fund, or one asset class, or at least they'd be taking a considerable risk if they did. It was another Nobel Prize winner, Professor Harry Markowitz, who first emphasised the importance of studying the risks and returns of an entire portfolio.
Really, the cornerstone of all what we call modern portfolio theory rests on this idea of diversification. And until Markowitz gave what was almost a engineering analysis of how stock price movements interacted with each other, nobody had ever really considered it. Even though prices don't move in nice sort of, let's say, sine wave fashion, prices do go up and down through time. So a stock's price will go up, it'll go down, sometimes many times over the course of a day, but certainly over longer periods of time. And basically what he discovered was, that's true and every stock does that, but they don't do it at the same time. And it's almost like if you think of two sine waves that are in opposite phase with each other, they will ultimately cancel each other out. And even though it was not the case that these stocks were in opposite phase, but as long as they weren't in exactly the same phase with each other, you still got some dampening effect.
Then in the 1960s came another important breakthrough when Professor William Sharpe developed what he called the capital asset pricing model. The CAPM, as it's often referred to, is a model for determining the price of a capital asset, such as a stock or a bond, in an efficient market. The price, Sharpe deduced, depends on two things. First, the risk of holding that security when markets fall, and secondly, the expected return. Ideally, he concluded, an investor should hold all the available securities in a particular market. And just in case there are any doubts about his academic credibility, Sharpe also won the Nobel Prize.
In the CAPM, Sharpe also introduced the concept of market beta, the measure of the volatility of a security or portfolio in comparison to the market as a whole. Sharpe referred simply to market risk, but in the decades that followed, fellow academics identified specific types of risk, or beta, often referred to as factors. This gave rise in the 1990s to the Farmer-French three-factor model.
What we mean by factors are things that drive common variation across stocks. So if I'm trying to say, well, airline stocks tend to move together, you could imagine an airline stock factor because it's going to pick up common variation. Or if you say, well, some stocks tend to move a lot when the market goes up, some stocks don't move so much when the market goes up. We could have a market factor in there that just picks up the difference in the way the stocks move relative to the market. We happen to know small stocks tend to move together and big stocks tend to move together. Put together a size factor, something the way we defined it, had lots of small stocks and was short lots of big stocks, that would pick up that variation between how small stocks behave and how big stocks behave. So there was the overall sensitivity to the stock market. We also knew small stocks had a higher premium than big stocks, and small stocks tended to move together relative to big stocks. And then we also knew value stocks, companies whose ratio of book to market or earnings to price or cash flow to price, something where it was a fundamental of the company divided by the price. Those value stocks tend to have a higher average return than growth stocks.
To the original three factors, market risk, size and value, French and Farmer have since added two more, profitability and investment. So companies with higher future earnings will have higher stock market returns. And perhaps surprisingly, firms that increase capital investment tend to produce poorer subsequent performance than those that don't.
Actually, those two factors, profitability and investment, explain the value factor. So you can actually drop the value factor if you want to and use a four-factor model. Will there be factors in the future? Possibly. A model stands until it doesn't stand anymore, until a better one comes along.
Now, some of that might sound a little complicated, but these are the basic building blocks of what is often referred to as the science of the capital markets. These are very important principles with implications for every investor. So before we apply these principles, let's recap.
Markets are competitive and there are two sides to every trade. The price of a security is the very latest best guess estimation of its value by the entire market. Because it incorporates and reflects all the available information, markets are therefore very efficient. Asset prices respond to new information, which is by nature random. Price movements are therefore random as well. And because the prices of different assets go up and down at different times, it pays to be diversified. The optimum portfolio is one that holds every security available. The return you can expect from a particular security is related to the risk of holding it when markets fall, and that risk is known as beta. But there are different types of risk you can expose yourself to. Small company stocks and value stocks, for example, are generally more volatile than larger company and so-called growth stocks. But if you hold on to them for long enough, they should deliver a higher return.
So how can ordinary investors apply that academic research, the lessons learnt from more than 100 years of rigorous research? How can they apply that to achieving their financial goals? Well, this might sound dramatic, but the work of Louis Bachelier and of Nobel Prize winners like Samuelson, Sharpe and Farmer should make us question everything we thought we knew about investing, and almost everything the industry and the media is telling us we should be doing.
Most of all, the evidence should make us extremely wary of anyone who claims that they have the knowledge to beat the market. Because markets are fundamentally efficient, consistent outperformance is almost impossible. So instead of paying large sums in fees to act active fund managers to deliver average returns, we should invest instead in passive funds that simply track an index at a much lower cost. Ultimately, though, it's not about theories or intellectual arguments at all. It all boils down to simple mathematics.
If you think about a marketplace and you think about a strategy in which an investor buys a proportionate share of all the securities. So if you have 1% of the money in the market, you buy 1% of each of the stocks. You buy 1% of each of the amounts of each of the bonds outstanding. So you have this truly representative market portfolio. If you think about that strategy, and then you think about all the people engaging in other strategies, active strategies, holding disproportionate amounts of this or that, then you ask at the end of any period, be it a year, a month, you name it, what did the passive investors, the index fund folks, earn before costs? And let's say that's 12%, just to take a number. And then you ask, what did the average euro or whatever currency it may be invested by all the active managers earn before costs? It has to be the same number. If the total made 12% and a subset made 12%, or the other bunch, the average euro in that sector had to make the same amount before costs. After costs, it's a different story. A well-designed index fund should have a very low cost of management. It should have very low turnover, very low transactions costs. Actively managed funds, by their very nature, have higher management fees. They employ more skilled people. They also have transactions costs because they're active. So net of costs, the average euro in the passive sector must outperform the average euro in the active sector. And that's just arithmetic.